Hey guys, Taylor the GammaEdge here, coming at you with a market recap from March 21st, 2025. Recap of the price action today, pretty big gap down. Then we, kind of trended higher the rest of the session. Let's get into pre-market prep first, and then we will review a couple, trade opportunities that we saw intraday. So first, looking at the market trend model, broad uptrend in the short term. The way we define that is using the cumulative tick, which is based off the tick index, which is a measurement of broad buying and selling in the market. We create a time series out of the intraday tick. So again, we can kind of create these trending models that we have. So again, coming into the session, we were holding the short-term uptrend, a bit of consolidation on Thursday. But the thing that we did notice on Thursday was 52-week lows was outpacing 52-week new highs, which, just in a vacuum is not constructive to see. So while the market trend model was looking constructive and kind of has been looking constructive since that reversal on Friday, what has been concerning still that has us cautiously optimistic is the structure of the SPX. Looking at SPXA, which again is just your monthly or quarterly expirations, it continues to be put dominated. We are not seeing any persistence of call speculation coming into the structure. Yes, we understand that there actually is call speculation in the structure, but relative to the put speculation in the structure, those put speculators are currently, in control. As shown here, we can see, a bunch of red, which is just put dominated strikes at the end of the day. Then coming into SPXP structure, which again is PM settlement, that is much more your short term, your 0DT, your weekly options, those turn over a lot faster. We like to focus on that as short-term traders because we think this is where a lot of the short-term speculation takes place. Anyways, again, structures are very similar. Mostly call dominated strikes above the spot price, not constructive of what we want to see for a healthy market, which is a lot of call speculation. Additionally, what we can do here is we can look at our DEX transition zone on this full complex. We can understand where price is trading in relation to that zone. And again, Thursday, we closed below the Friday pre-market transition zone, which is not a great start. And then obviously we gapped down and continue to live below this transition zone. So until we can get above the transition zone, well, really it starts with a tightening of the transition. So you can see how wide it is. That's just evidence of, markets in transition. Or, when we're in a declining market, we just do frankly see this transition widen. So until we can start to see this tighten up and then ultimately getting on the right side of the transition zone, which should correspond with calls coming back into the market, we remain cautious overall. So then coming into the SPX 0DT complex, here we have our transition zones drawn out for you. The purple box is our DEX transition zone, which is based off of delta. Ultimately, that is just a measure of the distributions of calls and puts and sentiment in the market. We want to understand where those strikes and all strikes above are call dominated. Then when those strikes and all strikes below are put dominated, this marks the top and the bottom of that zone. Then we have the drunken sailor zone, which you can effectively think of this as, yes, it spans outside of the DEX transition zone, but these are really peaks in the structure where between those two goalposts, volume and intraday volume is really going to push around price because the moneyness of the options and the back and forth nature between call and put dominated strikes is not necessarily going to play a big part in the actual moving of the strike price. So really our framework, we want to understand when we're between these zones because we expect chop action. Then once we get above these zones, this is where it's a lot easier for price to progress higher. When we take out the top of the zones, or price is able to move lower when we break below those zones. And then obviously layering on if volume is supporting that as well or not. So now going to the trading session today, we can see that we gapped well below both the DEX transition zone, which is this right here, and then our drunken sailor zone, which is this right here. And we knew that below us, we had the key 5,600 kind of psychological level. The one thing to note, as we started opening up today, looking at our intraday volume analysis. Again, for those first time watching these videos, what we do is on 5-minute time frames, we look at the distribution of call and put volume. We find the middle point of that distribution, which is called the centroid, and then for the call side, we plot those here. For the put side, we plot those down here. Every 5 minutes, there's a new point. We connect the dots, and there we can understand trends in the market. And the reason those trends are important is because they're ultimately the sentiment of the call and put speculators on the day. And we can assume all things equal, if the trends so far persist the rest of the session, we can understand what those lines of best fit are, and we can plot those through the close. And those kind of act as our guardrails for the day. And so all of that to say, earlier in the session, what we saw was an increasing put centroid, a decreasing call centroid, which generally this is the profile of choppy market conditions. However, we're not expecting huge ramps higher or lower. The reason for that is because, again, the choppy nature. There is really no side that is exerting their influence on the market. So, just as a reminder, when we see periods of big downtrends, we see this put centroid move lower, call centroid move lower. Uptrends, the put centroid is moving higher, call centroid is moving higher. Obviously not the character that we have right now. So again, the expectation here is that price is going to chop higher. However, what is important to note too is, we gap down significantly below our transition zone. So what this means is that there is a substantial amount of puts that are now in the money. Those speculators have a lot of profits from those positions that they held overnight. So the risk here now to the put side of the downside cases is those participants monetize those positions. So in order for us to see a material progression lower, we need to really see that calm put centroid trend lower, which tells us that new capital is being committed lower. If we don't see that, then what we typically see is a mean reversion move back into the transition zone, which, newsflash, that is what we got today. However, as it specifically relates to you and how you can make money on this, what we did in the community today was a lot of people were selling put credit spreads below 5,600. The reason for that is what we just talked about how we are not seeing a material decline in any of these centroids. And then two, 5,600 was a key psychological level. So as long as we could hold this level and we didn't see any, material declining in intraday action, then we were comfortable with those, put credit spreads that we sold below those levels. And so just playing this out the rest of the session, what you're going to see is, again, these centroids continue to hold their character throughout the session. And ultimately, it was a fairly choppy day with a, slight upward bias back into those transition zones. So again, the reason why this is important and why the tools are important and talk to each other is A, we knew where our transition zones were. B, we got a significant move as in gap down at the start of session. We were not seeing any follow through in terms of the put side transacting lower in a material way. In fact, it was trending the opposite direction. And then we saw these key downside levels holding as well. So, each time that we got a bounce off the lows, this was an opportune time to sell a put credit spread. The reason for that is because we had clear things to watch for to invalidate when that trade no longer worked, aside from just a price level being breached. Why? So long as this put centroid was trending higher, that gave us confidence to continue to do this throughout the session. So where do we go from here? The market trend model is, again, on a short-term basis, is deteriorating. Well, not again. I mean, coming into the session, we were still fairly constructive. However, we are back below what we call the railroad tracks, which is just a simple moving average ribbon. The trend is lower now as well. We saw a big outperformance of 52-week lows versus new highs. Fortunately for the bulls, what we have not seen is large and significant selling coming to the market. Right, this is our filtered tick, which is measures when the tick itself is plus or minus 1,000, which is a generally accepted benchmark by the market as being large, significant transaction. So that is the one bright spot. However, keep in mind, SPX structure is still put dominated. We need to see that improve before we get, bullish on more of a longer term time frame. Think swing type time frame. So until then, still much more just gonna be focused the 0DT, kind of credit strategies. Really just taking advantage of the intraday volatility until conditions start to improve to where it makes sense to start redeploying more longer term capital in the market. So with that, hopefully this was helpful. You should have an understanding of how we take our pre-market game plan in terms of those levels, those transition zones, and we're able to formulate trades intraday using those key levels and our intraday volume analysis. So with that, y'all have a great weekend, and we will see you all next week. Okay, bye.